Hi students, how are you? Can you hear me? Okay, thank you very much. I welcome you all in another session of the crash course of strategic business reporting. So in last two sessions on Saturday and Sunday, my focus was on the group account, consolidated financial statement. And we do practice number of questions, and I try to uh, give you a sense that how the group account question we will attempt in in our exam of strategic business reporting. And in that regard, for knowledge purposes, I also have provided you the volume 3. Hopefully, you people have go through the notes. So now I'm moving towards the other question. In exam, as you know, the question number 2 question number 2, dear student, this question will be consist of 20 marks. This question will be consist of 20 marks, first of all. Number 2, in this question, there will be an accounting problem which we need to discuss or explain in the paper. That accounting problem, for example, it could be an issue from IS 37, provisions, contingent liability, contingent asset. It could be regarding the post-employment benefit, IS 19. It could be from IFRS 5, asset held for sale. It could be from revenue. Accounting issue could be from IFRS 9, IS 32. Any accounting standard can be tested in this question. So there will be an accounting problem regarding to any accounting standard or accounting situation or about any accounting transaction. But this accounting problem will also accompanied by an ethical issue. Like, for example, if I give you a very basic example, like, for example, you have investment properties, and there are number of investment properties you have in different areas. Now, your senior, like, for example, the chief executive officer of your company or the chief financial of your company comes to you and asks you that the investment properties which are located in a developed area, they ask you to measure them at fair value model. But the properties which are located in a backward area, they ask you to continue to carry them under the cost model. and plus they threaten you that like they intimidate you that look, if you don't do it, if you don't follow my instruction, your promotion is in my hand, your bonuses are in my hand, and if you do it, you will get a good bonus on the basis of the target profit achieved. So basically, they are trying to convince you that the properties with the good price should be carried at fair value, and the property which does not have a very upward fair value increase, they should continue to carry under the cost model. And the objective is obviously that the profit in a profit and loss account could be reported um, with the positive figure. But accounting issue here is that investor properties can be carried under the fair value model, but pick and choose is not allowed. All the investment properties, if you want to use the fair value model, then all the investment properties must be carried under the fair value model. Pick and choose is not allowed. Now here your manager is asking you that you should carry certain properties under fair value model and certain properties under the cost model. It is contrary to the accounting standard IS 40. So that is, for example, an accounting issue. We will discuss it that it is not allowed. This discussion will base purely on the basis of accounting rules, accounting principles, and accounting standards. Now, in that scenario, there is an ethical issue as well for your senior and as well as you. For your senior, it is the question of his professional integrity, his professionalism, because they are pressurizing you, they are intimidating you that you do certain things which are contrary to the standards, contrary to the regulations. So that is an ethical issue on the end of your senior. But at your end, you also in an ethical dilemma. You have financial benefits associated with that job. So that would be clicking your mind. Okay, if I don't follow his instruction, my job may be lose, my bonus may be cut. So these things would be affecting you, being an employee, being an accounts manager. So that is an accounting issue for you. Then you may have also self-interest, because if you follow the instruction and if you do the things as per the direction of your senior, what will happen? You will record those properties at fair value which has an upward fair value, on which you can book a fair value gain and you can report that gain in a profit and loss account, so that the bonus target would be fulfilled and you will get a handsome bonus. So that is an ethical issue at your end. So we have to identify the ethical issue. Then we have to identify what are the principles which we should follow. And we know that being an ACCA member, being an ACCA accountant, or being any professional body accountant, it is our prime responsibility that we should do our work with integrity, objectivity, and professional behavior, and so many things. We should not associate ourselves with any information which we know is false or mispresentation of the fact. We should avoid it. So that is the principle. Then what is the course of action for us? That would be, we should discuss the thing with the CEO first of all, that look, it is not according to the applicable standard. If he understand, okay. If he does not understand, you have another option that you can take this issue to the audit committee or the board of directors. There is a concept of NADs. If the position is, if the situation, if the problem is not resolved there, you at the end you can consider the resignation, because being a professional accountant, you cannot go against the integrity, objectivity, professional behavior. So this type of the question will be tested in a question 2 of your SBR exam. So there will be an accounting issue, and that accounting issue may involve an accompanied by the ethical issue, which we have to discuss, and we have to give a reasonable solution which can minimize the risk regarding the ethical values in that case study or in that scenario. So that is the question number 2, and it will always be there in your exam, and mostly this question purely based on discussion. You have to discuss it, you have to explain it, and to answer this question, normally they give you only one response option, that is the word option, word response. Word response means the MS Word will be given. So you have to type the answer. Now, uh, we will now do practice number of questions on this issue, on question number 2, and after that we will move to the question number 3 and then question number 4. And during the question practice, there will be various accounting standards which we will be discussing as per we have in that particular question which we would be doing practice. Okay. So in this regard, I am going to start from a past paper, which is from March, June 2021. Okay, this is the question number 2. This is the question number 2, and this is a background of the question. It is about a company which has a name of Bismuth Company. It's a mining company, and investor in a B company receive earning from mining projects as a return on investment. The year end is 31st December 20x7. And there are 3 exhibits. There is one exhibit, one accounting issue is relating to impairment test of mines. Now, impairment test. Now, as we have word of impairment testing, our mind must immediately start to think about IS 36. Impairment is where the carrying value of the asset or group of asset is greater than the recoverable amount. Recoverable amount is higher of value in use or fair value less cost to sell. Okay, and value in use is the present value of the future cash flow from the continuing use of the asset discounted at pre-tax rate of return. Then there is a cash generating unit. Then on cash generating unit, there is an impairment allocation, goodwill, specific asset, goodwill, and other non-current asset on pro rata basis. So these things should come in our mind. These things should be in our fingertips. So there is one accounting issue will be about the impairment of the mine. Then there is Class A and Class B shares. The second issue is about the Class A, Class B shares. Class A, Class B shares means financial instrument. So as we have an accounting issue with regard to financial instrument, it might be about presentation of the financial instrument, which is IS 32, or maybe about the accounting of financial instrument, which is IFRS 9. Then there is an exhibit about the blockchain technology. Blockchain technology. And on that blockchain technology, we have an ethical issue created by the implementation of the blockchain technology. Now, when the blockchain technology would be implementing in the company, there might be some ethical issues. So that would be the exhibit number 3. So that is a background. Now, one by one, we will look into the question, but first of all, look at the requirement. First requirement is of 5 marks. and it is about the exhibit number 1, which require us to discuss to discuss with suitable calculation whether the B company should recognize an impairment loss for the mine. Very simple requirement, very easy requirement, that whether we should discuss whether the B company should recognize impairment loss for mine. Not, dear student, an impairment loss should be recognized if and only if the carrying value of the non-current asset is greater than recoverable amount, then yes, impairment loss should be recognized. And if the situation is contrary, then impairment loss should not be recognized. It's a very simple rule in IS 36. So they want us to apply this rule and to discuss that whether impairment loss should be recorded on the mine. Now, this is the exhibit. This is the information. Kindly read this. Kindly read this. So as at 31st December exits, a B company owns mine which have a carrying amount of 200 million. Okay. 200 million is the carrying amount. The company has committed itself to decommissioning its mines at the end of the useful life, 5 years or less, and has created a decommissioning provision of 53. However, the directors are unsure how the decommissioning provision will impact on the impairment testing of the mine. At the end of the useful life of the mine, its reusable component will be dismantled and sold. So carrying amount of the decommissioning provision is 53. Sale of reusable component at the end will be 20. Sale of mining output inflows presently will be 203, and the operating cost will be 48. Now, the question is whether the impairment should be recognized. We will start from that. What is the impairment? Impairment is when the carrying value of the asset is greater than recoverable amount, and company should record the impairment. Recoverable amount is higher of fair value less cost to sell and value in use. If the cash flow of the individual asset is not identifiable, then the entire cash generating unit to which that asset belongs should be tested for impairment. So the mine is itself is a cash generating unit. So the mine should be tested for impairment. Now to determine the impairment loss, we need a carrying value. Carrying value is 200. The other thing is recoverable amount. Now, the recoverable amount is higher of fair value less cost to sell or value in use. There is no fair value less cost to sell. So here the recoverable amount will be the value in use. But the other thing need to be discussed here, the treatment of the decommissioning cost. Now, dear student, decommissioning cost is a liability which, according to IS 36, the decommissioning cost provision should be deducted from the carrying amount of the asset and its recoverable amount, which is value in use, to conduct the impairment test. So, to conduct the impairment test, the carrying value is 200 minus 53 decommissioning cost. So it will become 147. Then you need a recoverable amount. Now recoverable amount is value in use. Now value in use is equal to 223, 20 plus 203 plus 48. So it will be it is 271, and the provision for dismantling will be deducted from this value. So the recoverable amount is 218. So the carrying value is 147, value in use is 218. So the carrying amount, so you can see the carrying value is less than the recoverable amount. So in this case, if this is the situation, then no impairment should be recognized, because here the carrying value is less and recoverable amount is more than the carrying value. And in that situation, impairment loss should not be recorded. Okay. Now let me show you that how they have okay, just a minute. Just a minute. I commit. Okay. This 48 is it is an operating cost. Just a minute. It is an operating cost. It's an operating cost. So basically 20 plus 203 minus 48. Just a minute. So it is 20 plus 203 minus 48. So it is 175 minus 53 decommissioning cost. Just a minute. So the value in use is 122 and carrying value is 200 minus 53. So it is 147. Yes, impairment should be recorded because the recoverable amount is 122 and the carrying value is 147. Okay. This 48 is an operating cost. It should be deducted. So the value in use 175 minus decommissioning cost, as I told you, to conduct the impairment test, the present value of the decommissioning cost will be deducted from both the value of the asset and value of the value in use, recoverable amount. And then if you compare the carrying value 147 with the recoverable amount 122, recoverable amount is less than carrying value. So yes, impairment loss should be recorded. Impairment loss should be recorded. You got it? Now look at how they have discussed IF 36 here. Most liabilities are ignored when calculating the recoverable amount in a impairment testing. However, certain liabilities such as decommissioning cost cannot be separated from the related asset. Decommissioning cost is part of the asset cost. As you know, we capitalize the decommissioning cost at present value on the initial recognition. So IF 36 impairment of asset require carrying amount of the recognized liability to be deducted from both the carrying amount of the cash generating unit and amount determined using the value used. The recoverable amount of the asset should be determined using value used model in IF 36. The amount of decommissioning provision is used to calculate the net recoverable amount by deducting from the value used amount. The net recoverable amount is then compared with the carrying amount of CGU, which should be adjusted to include the decommissioning provision in accordance with IS 37 provisions, contingent liability and contingent asset. Cash flow projection should be based on reasonable, supportable assumption, the most recent budget and forecast, and extrapolation for the period beyond budgeted period projection. IS 36 presume that the budget and forecast should not go beyond 5 years. For a period after 5 years, extrapolation should be used from the earlier budget. In this case, mines have a useful life of 5 years or less. Therefore, the cash flow projection can be used to implement the impairment test. So, first of all, they have calculated the value used. 20 sale proceed, 203 sale proceed, 48 is the operating cost, cash outflow, and 53 is the decommissioning cost present value. So this is the recoverable one, 122. And 147 is the carrying value, 200 minus 53. And the carrying value is greater than recoverable amount. So you have to record an impairment loss of 25 million, on this mine. So here you can see it's a pure accounting issue relating to IS 36. And this is question number 2. Got it? Then there is another requirement. And this is discuss, again discussion. Discuss whether the class A and B shares should be classified either as equity or liability in accordance with financial instrument presentation. So it's an accounting issue of IS 32, that whether the company who has issued the financial instrument, how that company should present the financial instrument in financial statement, whether it should be presented as a financial liability or whether it should be presented as an equity. And IS 32 give us very clear-cut direction. Number one, if in a substance, according to the substance of the contract, if there is obligation to pay cash, if there is obligation to pay cash, then a financial instrument should be presented as a liability, like loan note, debenture, redeemable preference shares. Or if there is no obligation to pay cash, then it should be presented as an equity, like ordinary shares, where we does not have an obligation to pay cash, we have discretion to pay cash. It is up to the management whether they want to purchase back the share or not in the ordinary share. It is up to the management whether they want to pay the dividend or not. So there is a discretion. There is no obligation. So it should be treated as an equity. And in some cases, the entity has the choice to settle the instrument. Now, in that case, according to IS 32, if the cash settlement value is less than equity settlement, then in a substance, there is an obligation to pay cash. Or otherwise, it will be an equity. For example, the company has a choice regarding the class A share. That company can purchase the share at $3 per share, or they can issue ordinary share against the Class A share. And the value of the equity which would be issued against the Class A share would be $6. Obviously, in that case, the company will choose the cheaper option, that is to pay cash, which is less than the value of the equity. So in that case, the Class A share will be treated as a liability, as a financial liability. It would not be treated as an equity. So it is an issue of IS 32 that how the company will present the Class A and Class B shares. And further, if we are talking about a compound instrument, if we are talking about, then in that case, uh, that is consists of both the liability component and equity component. But now let's see what we have in a case study. Now, this is the exhibit. Exhibit 2, relating to requirement 2. Dear students, kindly read it. Kindly read this. Okay, have you read it? So if you have read it, okay. Now, if I give you a summary of this case study, there are two classes of shares, Class A shares and Class B shares. In both classes of share, it gives the right to vote in both classes. It gives right to entitlement to rewards. Rewards mean dividend. Rewards mean dividend. And in both classes of share, the company has a choice. Company has a discretion whether to pay the dividend or whether not to pay the dividend. So these characteristics are common in both in Class A and Class B shares. And due to these characteristics, it feels that the Class A and Class B shares both are equity, both are ordinary shares, and both should be treated as an equity instrument. Am I right? If you focus only on the first paragraph of the case study, dear student, please respond. If we focus only on the first paragraph, uh, by studying, by reading the first paragraph, it seems that both the Class A and Class B shares both are the equity instruments, both are the ordinary shares. Because in ordinary share, the holder has the voting right. On ordinary share, they have a right to dividend. On ordinary share, company has the discretion whether to pay the dividend or whether not to pay the dividend. Am I right? You people also have the same feeling when you read the first paragraph? Yes, students, I'm waiting for your response. Yes. Okay, that's great. Now, when you are writing the response of this question, you have to express your feeling. Okay, you have to express this feeling in your exam, that it seems that we are talking about the equity instrument. The Class A and Class B share both seems like an equity instrument. That need to be mentioned. That need to be mentioned. And why you are feeling that it is an equity instrument? Because of the characteristics which we have in a first paragraph of the case study. Okay, but now after writing this, then you will write a very beautiful word, however. It's a very magic word, however, then you will write however. And after that, your focus first of all will be on Class A shares. Now the Class A shares are contingent. They will become redeemable if the company get listing in a stock market, which is highly probable that it will get listing. So it means it is it will be a redeemable. The company has to redeem it. Now, when things are redeemable, then it seems like a financial liability. Like loan, note, debenture, they are redeemable. But again, however, in Class A share, it is, yes, it is highly probable that they will be redeemable. They will be redeemable. But how they will be redeemed, it is the choice of the B company. Company has the choice that how they will redeem the Class A share. And company has two choices. The choice one is that they will pay a cash equal to 1 Bitcoin for every 1,000 of the Class A shares, or they will issue shares, they will issue the shares which will be equal to the 2 Bitcoin for every 1,000 Class A shares, and the market value of the Bitcoin is 12,000. So if they have to pay, if they decide to pay the cash for every 1,000 shares of the Class A, they have to pay the $12,000 cash. But if they convert the Class A share into another share, for every 1,000 Class A shares, they have to issue $24,000 shares. And in option 2, the share which will be issued against the Class A share will be the Class B share. And if you read the last paragraph, from the last paragraph, it is very clear cut. I will explain it later, but if you read it, it is very clear that the Class B shares are equity instruments. Now, again, come back to the Class A share. Now, the company has a choice that how they will redeem it. Now, in this situation, the value of the cash redemption, the value of the cash redemption is less than the value of the Class B redemption, and the Class B share is an equity. Now, what company will go for? Obviously, the company go for the less value. If the company has a choice, they will prefer to issue or pay $12,000 cash rather than to issue 24,000 worth of Class B shares. Okay, so that gives us a sense that in a substance, the company will choose to pay the cash. So in a substance, there will be an obligation to pay cash. So that's why the Class A share, the Class A share should be presented as a financial liability. To be presented as a financial liability. You got it? Everyone? Now, let's talk about the Class B. Class B share, B company. For Class B share, B company is not compelled to redeem. So there is no obligation to redeem. But these shares do contain an option to allow the B company to repurchase. The company has a choice. If they want, they can buy back, but there is no obligation. And similarly, on a Class B share, the dividend payment is also a choice of the company. Okay. So this choice, when you have a choice, when you have a discretion, when a company has a discretion to redeem or not to redeem, or to pay the dividend or not to pay the dividend, if you have a discretion, it is a pure characteristic of the equity instrument. So that's why the Class B share should be presented as equity. They should be presented as an equity instrument. To be presented as an equity instrument. Got it? So this is the answer by the examiner. Kindly read the answer. IS 32 financial instrument presentation states that financial instrument is a financial liability. If it provides that on settlement, the entity will deliver either a cash or another financial asset, obligation to pay the cash, or its own shares, whose value exceed substantially all the value of the cash or other financial assets. Like here in this case, the value of the share was 24,000 and the value of the cash was 12,000. So the B in the first paragraph, they are just discussing in Class A, Class B share, they have a discretion, they have a voting right. The company has a discretion to pay the dividend. Both have the voting rights. It's in characteristics of the equity instrument. It should be, it's like, seems like an equity instrument. Okay. But in a second paragraph, they are talking about that in a Class A share, they are contingent, they become redeemable if company get the listing in a stock market. And it is unlikely, and it is highly probable they will get the listing. So the Class A share will become redeemable, and when they will become redeemable, then it should be treated as a liability. And why here it will be treated as a liability? Because the value of the cash payment, the choice to pay the cash, which is $12,000, is less than the value of the conversion into Class B share, which is 24,000 US dollars. So that's why the Class A share should be treated as a liability. And the Class B share should be treated as an equity. If the B company fails to exercise its call option on the Class B share, it must transfer an additional reward to the holder. An obligation must be established through the terms and conditions of the financial instrument. Anything outside the contractual term is not relevant to classification process in accordance with IAS 32. Therefore, the potential failure to exercise the call option does not affect the classification of the Class B share as equity, as there is no unavoidable contractual obligation to pay the reward or call the instrument. Also, if the call option is not exercised, the reward payable will only constitute an increase in dividend rate, not a redemption of the Class B share. Hence, the Class B share constitute an or a equity instrument. So, that is question number 2. And in question number 2, the first two requirements were regarding the accounting issue. Impairment, IAS 36, and presentation of the financial instrument, IAS 32. Now, there is a third requirement which is of 8 marks. Discuss ethical issue raised by the implementation of the blockchain technology for both the chief accountant and the finance director, including any appropriate action which should be considered to resolve these issues. Okay. So there is an accountant and the chief executive officer. And there is an issue regarding the implementation of the blockchain technology. And this is the case study. Now, in this part of the question, there will be an accounting ethical issue. First of all, read the given exhibit. Kindly read the exhibit. So the B company plans to implement the blockchain technology to store all of its data relating to its mines trading and certify the ethical sourcing of all its raw materials. The chief accountant, Miss Pleasant, is currently developing the blockchain technology. The chief accountant is in charge, is responsible for the development of the blockchain technology that will be filed for patent. Miss Pleasant has only recently taken up the post and has discovered that work done at her previous employer, Gypsum Company, is relevant to the project. If Miss Pleasant is disclosed this information, it will compromise the patent process at Gypsum Company, but will consolidate her position as a chief accountant in a B company. When she left the employment of the Gypsum Company, she signed a confidentiality agreement, but the clauses were not clear or specific about what information could be shared and with whom. So it is about the chief accountant. She is responsible for developing the blockchain technology, which will be filed for the patent. But the work which she is doing in a B company for development of the blockchain technology is the same work which she has done at a Gypsum, and she has got the experience from there. So now she is confused that whether that information should be used at the B company or not. Because if they do it, it will affect the Gypsum Company, the previous employer, but it will consolidate her position in a B company. And she also has signed an agreement, which is the confidentiality agreement with the Gypsum Company, but it is general kind. It is not specific to the blockchain technology. Okay. Now the second paragraph. Miss Pleasant has significant knowledge of blockchain technology. But the finance director, Mr. Fricklin, has limited knowledge of it or a new business model that the B company is trying to develop. Mr. Fricklin has told her that there is no need to spend a significant amount of time creating a technology to ethical source material. Ms. Pleasant is worried about Mr. Franklin's lack of technical and legal knowledge, as she feels that it will affect the development of the technology. In addition, some data concerning ethically sourced material has gone missing, and she thinks that Mr. Franklin has erased the data and sabotage the project. Mr. Franklin has told the board of directors, Mr. Franklin has told the board of directors that he has in-depth knowledge of the technology. So in a second, there is a conflict between the chief accountant and the finance director. Now the finance director is the boss, he is the senior, he has authority, but he does not have the knowledge or experience of new technology, blockchain technology. So it is a human nature that when, especially for those who are in charge, if they does not have the experience, if they does not have the technical knowledge, then they create hurdles in the path, in the way of the development. So the same thing is happening with Mr. Franklin. He does not have the knowledge. He does not have the experience. But Miss Pleasant has the knowledge. She has the experience. So Mr. Franklin is trying to sabotage. Mr. Franklin is trying to demotivate the Miss Pleasant and to stop her from developing the new technology. And another issue is that Mr. Franklin has told the board of directors, which is a lie on his side, that he has a sound knowledge of the blockchain technology. So that is the question, that is the information we have. And if we go back to the requirement, the requirement was ethical issue raised by the implementation of blockchain technology for both the chief accountant and finance director, and including any appropriate act. So first of all, ethical issue. And first of all, let's talk about the chief accountant. What do you think? What ethical issue she is facing at the moment? Yes, student. I need your input. Yes. Oh, one of the student, Mithilesh, has identified integrity and confidentiality. Yes, the chief accountant, Miss Pleasant, is basically first of all facing the confidentiality, because she is in a dilemma of confidentiality. Because she has worked at a gypsum, she got some experience, and with the use of that experience, she is developing a technology at the new employer, and she is feeling that it is not right. It is against the principle of the confidentiality, and its feeling is right because being an accountant, being an professional accountant, we should be alert on ethical issues. Okay, we should be alert on ethical issues. And if I'm saying, and if it's a confidentiality, and she used the knowledge to develop the same technology at the Bismuth company, then obviously it is against the integrity as well, because she is using the information of another employer to get the benefit from the new employer. Yes, then it would be the integrity issue as well. But the question is whether she is actually going against the confidentiality or not. Because if you think practically, you are an employee and employee do change jobs, and the experience they got from the previous employer, obviously that experience helps them to move in the next level of the their career. Okay, so it is debatable. It is debatable, and this debate we have to carry out. We have to carry out. Now it's a normal thing, as I told you. And one more thing which create an edge for the Miss Pleasant chief accountant is that she has signed the confidentiality agreement, but it is not specifically about the blockchain technology. So she is facing the issue of confidentiality, which she is think that she may be breach if she used that experience she got at a gypsum at the Bismuth company. That is an ethical issue actually it's facing actually. Now that is whether it is actually issue or not, that is debatable, but she is in an ethical dilemma of confidentiality and integrity. Another ethical issue which he is seriously facing is the intimidation from his boss, Mr. Franklin. Mr. Franklin is his boss, and it is presumed the person who is in charge is in a position to intimidate the junior employee. So these are the two ethical issues which Ms. Pleasant is facing at the moment. Now, what is the way out from here? One of the way out from here is that she can disclose this fact to the gypsum company that I am developing the technology at my new employer, and it is the same technology which you are developing. If she disclose it, so it would help him or help her to minimize this ethical dilemma. That is the one way she disclosed this. And as far as the second issue is concerned, that is very, very complicated because Mr. Franklin is his boss, and if she go against him, Mr. Franklin, if Ms. Pleasant go against its CEO, CFO, then it would create the future problem for her. So she needs to act very carefully. The appropriate and the most reasonable way to resolve this issue, she should talk with Mr. Franklin and try to convince her that it's a new technology, it is betterment for the company and for Mr. Franklin as well, and try to guide him that what is this technology, how it works. So by doing it, the situation might be resolved. But if it is not resolved, then she can go for the board where the entities are present. She can take this issue there. Now come to Mr. Franklin. What Mr. Franklin is facing. Mr. Franklin, the first ethical issue which Mr. Franklin is facing, it is the due care. Now, being an professional, it is our ethical duty that we should update ourselves with new changes in the profession. Like being an accountant, we know there will be changes in each year in a taxation. We know the law, the company law, the contract act will continue to change. There might be some changes in the law. In the recent times, we have some major development in accounting standards. Like in a recent time, if I give an example, we have IFRS 18 for financial statement, which replaces IAS 1. We have IFRS 16, IFRS 15. These are some accounting standards which are changed in last 5 to 6 years. So being a professional accountant, we should keep ourselves updated with the new knowledge. The things are changing continuously, so we need to update ourselves. But Mr. Franklin failed to do it. He was, due to some reason, he was unable to update himself with the new changes, with the new technologies, especially the blockchain technology. So it is an issue of due care. The service is the due care. He does not have the right knowledge. And the second about his integrity. The integrity issue arises when Mr. Franklin told the board of directors that he has the in-depth knowledge of the blockchain technology. It is against the integrity and professional behavior. And similarly, if the Mr. Franklin has erased the data, it is also against the professional behavior and integrity. So these are the ethical issues which Mr. Franklin is facing. So what is recommendation for Mr. Franklin? There is a program of ACCA which is known as CPD, Continuous Professional Development Program, which is mandatory for the members to complete in each year, so they can be aware of, they can update their knowledge about the new changes. He should go for CPD. He should go for new trainings where he can learn about the new things. There is no shame to learn anything. So he can go for training, he can go for CPD. So in that way, Mr. Franklin can overcome its ethical issues. Okay. Now, kindly read the first paragraph. First of all, read it. Read the first paragraph, please. So, Miss Pleasant is in a difficult position regarding the information gained at a previous employer. In general, she would respect the confidentiality of the information acquired as a result of professional and business relationship and therefore not disclose any such information to third party without proper specific authority unless there is legal or professional right or duty to disclose. In addition, she should not use information for her personal advantage. However, the situation will depend upon the nature of the confidentiality agreement with her previous employer. This agreement may have been made in order to protect commercially sensitive information to prevent her from sharing such information with B company. However, if the agreement is not clear specific, then it will be left up to the ethical consciousness of the Miss Pleasant as to whether she should uh, disclose the information. The purpose of the agreement is to prevent disclosure of this type of sensitive information and chief accountant ethical conscientiousness should prevail. In addition, the confidentiality agreement may be legally binding. So they are discussing the principle and they are discussing a practical point. There is no specific confidential agreement that she cannot use the information. Then normally the confidentiality agreements are about the commercial information like a major customer or any such type of information. So it is totally up to the ethical sense or ethical responsibility of the Miss Pleasant that what could be the right way. Opportunities and challenges presented by technology and new business model require evolving level of digital literacy by the accountant. Accountant should provide relevant decision useful analysis to ensure that the right technological application are adopted in the best interest of the business. New business model present opportunities for professional accountant to provide relevant advice on regulatory matters. This development requires growing set of competencies. These competencies relate to not only financial matter but also social impact assessment, environmental accounting, or other non-financial capital valuation technique. Obviously, Mr. Franklin obviously not aware of the importance of the entity being environmentally aware as he has told the chief accountant not to worry about. Ethically sourced material, data. Professional accountants need to expand their competency area to inside digital and social awareness. The fundamental principle of professional competence and due care require that professional accountant only undertakes significant tasks for which the professional accountant has or can obtain sufficient specific training or experience. A professional accountant should not intentionally mislead the employee as to the level of expertise or experience possessed, such as is the case with Mr. Fleckman, who has told the board he has in-depth knowledge of technology. Same points which we have discussed are elaborated here. Now, Miss Pleasant is in a difficult position as regard the competence and sabotage of project by Mr. Franklin. As an act of whistleblowing can cause conflict of interest between personal and organization and social welfare. This conflict stems from the way in which the white whistleblower is viewed. The chief accountant could be viewed as someone sharing knowledge of misconduct for the benefit of the other or someone who is acting disloyal to their superior. Miss Pleasant will be torn between loyalty to Mr. Franklin and her own moral commitment. As long as her motivation are sound, she is confident in a system and her knowledge, she should not hesitate to rely such information as she is helping to create environmentally aware project which will enhance company business. So, because she is in a difficult situation, Mr. Franklin is her boss, and she has not a clear evidence that Mr. Franklin is responsible for the sabotage of the data. So, what is advice for her? She is confident. If she is confident, she is motivation, then it doesn't matter that who is doing what. As far as she is committed himself to the project. So she should go with her motivation. And if I told you if the matter is serious, the first step is that she should talk with Mr. Franklin first about this issue. And then the other stakeholder should be involved as per the need. Okay? So here you have seen exam level question number 2. And as I told you, and we have discussed earlier that in a question number 2, there will be an accounting issue. As we have seen here, there was an accounting issue and evolving an ethical issue. Ethical issue. So the question 2 will always be like this. There will be an accounting issue and there will be an ethical issue. Any questions, students? So any questions, students? Okay. Now another question. Again, question number 2. So we have two requirements here. One is discuss the accounting treatment which firm should adopt to address each of the issue above for consolidated financial statement. So accounting treatment, and B, discuss the ethical issue arising from scenario including any action which Farham and the accountant should undertake. So here we have the background of the question and the first exhibit. Now, dear student, first of all, read the background. Read the background is very important. Kindly read the background of the question. Okay, so Farham manufacturer is the washing machine, dryer manufacturer, dishwasher manufacturer industry is very competitive. There is lot of competition. Brand loyalty is very important in this industry, and the company also operate a profit related bonus scheme. Profit related bonus scheme. Now, the profit related bonus scheme always motivate the employees to do something to increase the profit by window dressing or through manipulation. Okay, for its manager based upon the consolidated financial statement. But the recent results have been poor, and bonus target have rarely been achieved. As a consequence, the company is looking to restructure and sell 80% its own subsidiary New Wall, which has been making substantial losses. And the current year end is 30th June 2008. So this is the background. Now, the exhibit number 1. The factory subsidence. The Farham has a production facility which started to show sign of subsidence since January 2008. Subsidence is some sort of damage. Okay, and the sign of that damage is appearing since January 8. It is probable that Farham will have to undertake a major repair sometime during X9 to correct the problem. They have to take a repair activity, and that activity will be in X9. Farham does not have an insurance policy, but it is unlikely to cover the subsidence damage. The chief operating officer refused to disclose the issue at 30 June next 8, since no repair costs have yet been undertaken, although she is aware that this is contrary to the international accounting standard. The chief operating officer does not think that subsidence is an indicator of impairment. She argued that no provision for the repair to the factory should be made because there is no legal or constructive obligation to repair the factory. Farham has a revaluation policy for property, plant, and equipment, and there is a balance on revaluation surplus of 10 million in financial statement for the year ended 30th June XA. None of this balance relate to the production facility, but the chief operational officer is of the opinion that this surplus can be used for any future loss arising from the subsidence of the production facility. So they have a revaluation surplus of 10 million, but that is relating to some other class of the asset. But the chief operating officer is of the opinion that any loss, if they have any loss, impairment loss on the factory building, that loss should be offset against the revaluation reserve. So there are three accounting issues here. One is IAS 36. About impairment. Now, dear student, here the chief operating officer opinion that it's not, and the subsidence of the building is not an indication of impairment is wrong. That opinion is not appropriate. Subsidence is an impairment indication. And whenever there is an impairment indication, we need to carry out the impairment test, in which we need to determine the recoverable amount, which is higher of fair value less cost to sell or value in use. But sometimes the cash flows that are not identifiable for the asset. Means the single asset is not a cash generating unit, which is the factory building. Factory building is not a cash generating unit because the factory building cannot generate cash on itself. There will be other asset as well which act combinedly and they generate the cash flow, and that will be the factory. So, and the factory building is part of the factory. So here the factory is the cash generating unit, and that factory should be tested for impairment, as the subsidence as is an impairment indication. And if there is an impairment loss should be recorded. Number one. The second issue here we have is IS 37, provisions, contingent liability, and contingent assets. Now, the chief operational officer opinion that no provision should be recognized for repair and maintenance. He is right. Chief operating officer in this regard is right, because repair is a future operating cost, and there is no obligation to carry out the repair work in a future. So there is no need to recognize the provision. So as far as the provision is concerned, no provision should be recognized. The third issue is from IS 16, revaluation reserve. Now, dear student, if you have a revaluation reserve and there is a revaluation loss, the revaluation loss, first of all, should be offset against the revaluation reserve, but relating to same asset or same class of the asset. Now here, this 10 million is relating to some other class of the asset. So no impairment loss of the factory building can be offset against this 10 million. So here the opinion of the chief operating officer is not right. The loss, the impairment loss on the factory building cannot be offset against this 10 million revaluation reserve. Okay? Any issue? Any question by any other student? Okay, Hashim. Look, in question number two, there is an accounting issue and then there is an ethical issue. So to discuss the accounting issue, you should have the knowledge of relevant accounting standard. That is must. You remember or not the accounting standard number, it might be debatable, but the name of the accounting standard, the accounting treatment, according to the relevant accounting standard should be very clear. If you only discuss the ethical issue, that will get the marks relating to ethical issue only. Now you have a 20 marks question. Out of 20, 10 marks will be relating to accounting issue and 10 marks would be relating to ethical issue. So accounting standard knowledge is still important in question number two. Okay. Okay. Now read the answer that how they have discussed this accounting issue. And look at here. They have also involved IFRS 13 fair value measurement because fair value less cost to sell. IAS 36. So fair value. And for fair value, we have IFRS 13. IFRS 13. So now read the answer. So have you read it? 36, 16 and IS 37. Now another accounting issue, sale of new wall. Now kindly read the exhibit. Kindly read the case study. So at 30th June, they had a plan to sell 80% of the subsidiary. The plan has been approved by the board and reported in a media. And it is expected that Oldcastle, an entity which currently owns the other 20% of the new wall, will acquire 80% of the equity interest. The sale is expected to complete by December exit. New wall is expected to have substantial trading losses in a period up to sale. The accountant of the firm wished to include the expected cost of disposal and future trading losses. The COO does not wish new wall to be disclosed as a held for sale, nor to provide the expected losses. The COO is concerned as to how this may affect the sale price and would almost certainly means bonus target would not be met. The COO has argued that they have a duty to secure a high sale price to maximize the return for shareholder of Farham. He has also implied that accountant may lose his job if he were to put such provision in a financial statement. The expected costs of the sale are as follows. Future trading losses, legal costs, redundancy costs, impairment loss, and included within the trading losses is an early payment penalty of 6 billion for a lease asset which is deemed surplus to the requirement. Now here, first of all, accounting issue is relating to IFRS 5, asset held for sale. Now, the company for which they have decided to sell, dear student, it should be classified as held for sale. It should be classified as held for sale because they have actively started to look for the buyer and they have identified the buyer, Oldcastle, and sale is expected to be completed within 6 months. And the board has approved the plan. So it is held for sale, first of all. Now, whether it is discontinued operation or not, it depends that whether it fulfills the definition of the discontinued operation or not. But held for sale is obviously it is held for sale. Number two, accounting issue of IAS 37. Dear student, it is a restructuring also. And for restructuring, the both condition, formal plan and communication has been done at the year end. So a restructuring provision should be recognized. But while recognizing the provision, we need to keep in mind that IAS 37 does not allow to record the provision relating to future trading losses. Future trading losses should not be part of the provision. Only the direct expenditure like legal costs, redundancy costs should be part of the provision. Future trading losses and impairment losses should not be part of the provision. So 7 million and 6 million, the early payment penalty on a lease asset should be part of the provision. So total value of 13 million of provision under IAS 37 should be recognized. So Chief Operating Officer, with regard to the recognition of provision of future trading losses, he is right. But regarding the legal cost, redundancy cost, and penalty, a provision of 13 billion should be recognized, and it is held for sale asset. It is held for sale asset, and it should be disclosed as held for sale. It should be disclosed as held for sale. So that is the second accounting issue. That was also an accounting. I haven't discussed the ethical issue at the point. I am only talking about accounting issue. Now, and after that, in the second part of this question, we will discuss about the ethical issue. So first of all, kindly read the answer relating to the second part. So it meets the held for sale criteria. Management shown commitment to the sale by approving the plan and reporting to the media. Acquirer has been identified. Sale is highly probable as it will be expected to complete within 6 months. So it should be treated as held for sale. Now, whether it is discontinued operation or not, it depends whether it is a major product line or geographical area part of the coordinated plan. If it is, then it will be also treated as a discontinued operation. And asset held for sale are measured at the lower of carrying amount or fair value less cost to sell. The carrying amount consists of net asset and goodwill relating to new wall less the NCI share asset within the disposal group which are not within the scope of IFRS 5. This includes lease asset. It is highly likely that the lease asset deemed surplus to requirement should be written off with the corresponding expense to profit and loss. Any further impairment loss recognized to reduce the new wall to the fair value less cost to sell would be allocated first to goodwill and then on pro rata basis. When you carry it at lower of carrying value of fair value less cost to sell, there might be impairment loss, and if it is a cash generating unit, then first of all specific asset, goodwill, and then other non-current asset on pro rata basis. Here they are talking about the allocation of impairment loss. Now, if we talk about the provision of 13 million should be recognized. Yes, the provision for the future trading losses should not be recognized. Provision for the impairment should not be recognized. For 13 million, which include redundancy cost, legal cost, and the termination charges of the lease, these should be included in a valuation of the provision. Now, the ethical issue. Now, accountant have a duty to, as you know, have a duty that financial statement should be true and fair. They should present a true and fair view. Now here the accountant, we are talking about the accountant. Accountant have some problems here in a number of areas, especially in a Farham case, factory subsidence case. The accountant was of the opinion that the provision for repair expense should be recognized, and IS 37 does not allow or does not give us permission to recognize provision for repair because it is not a obligation, not a present legal obligation or the constructive obligation. Number two, again, the accountant in new case of new wall is emphasizing to recognize a provision for future trading losses and impairment on goodwill. And here the provision recognition is not allowed. Okay. So it gives us the idea, the lack of knowledge on the part of the accountant. And being an accountant, he should be supposed to carry out its work with professional competence and due care as per the relevant accounting and professional standards. So he is in a breach of professional competence and due care. And what is the way out for the accountant is that the accountant should attend CPD's continuous professional development program. He should attend professional development courses to update the knowledge. That is about the accountant. Now come to the Farham, the chief operating officer of the Farham company. The chief accountant is also happy to manipulate the financial statement by not treating the factory subsidence as an impairment indication, by not treating the new wall as held for sale, and by arguing that the loss of the factory subsidence, impairment of the factory should be offset against the revaluation surplus of the 10 million, which is related to other assets. And in the new wall case as well, where the provision should be recognized of 30 million, the chief operating officer of the company is of the opinion that provision should not be made. Now, if the chief operational decision maker is doing it unknowingly, then it is the question of professional competence and due care. but it seems that he is doing it willingly. He is manipulating the financial statement or trying to manipulate the financial statement willingly, which shows the question of integrity and professional behavior. Now, why I am saying that he seems to do the manipulation regarding the not recognizing the provision and not treating the impairment of indication of the factory subsidence and not treating the new wall as held for sale because the bonuses, the back, keep in mind the background of the question. There are the bonuses which depends on the uh, profits of the company. So if and the profit targets are hardly meet, they are hardly fulfilled. So if they recognize these provision, so there is a chance that the profitability would reduce and they would not get the bonuses. So that's why it seems they are happy to uh, uh, do the manipulation, do the window dressing in the financial statement. So that's why it is a question of not a professional competition. You get it is a question of integrity and objectivity and the professional behavior. And it is due to their self-interest, profit bonuses. Chief operating officer is also acting unethically, which is against the integrity, that the chief operating officer is threatening the accountant that the accountant may lose the job. It is called intimidation, and it is also against the ethical framework. Being a qualified accountant, you should know that it is not acceptable that you intimidate your juniors to carry out some work which is not as per the standard, accounting standard or professional standard. It is totally unacceptable. So the accountant obviously in ethical dilemma. So what accountant should do? First of all, for the professional companies in UK, he should go for the CPD program. But as far as the threat from the chief operating officer, first of all, he should talk with the chief operating officer. If it doesn't work, he can talk with the board of directors. There is an audit committee. At the end, if the situation is still not resolved, he can consider the resignation or he can contact with the ACCA ethical helpline to discuss the issue and to take the further guidance, keeping in mind the confidentiality, okay? And very important line, the chief operating officer claimed that our duty is to maximize the shareholder wealth. Yes, being a manager, it's our duty that we should work for the best interest of the shareholder. But going against the accounting standard, going against the rules, regulations is not in the best interest of the shareholder. Go with the standard, compliance with the standard, compliance with the rules and regulations is in the best interest of the shareholder. So we will also challenge that opinion of the uh, chief operating decision maker. So again, you have seen another question where there is an accounting issue and then there is an ethical dilemma or ethical problem in that question we have discussed. Okay, so question number two will always be like that. Any question? Okay. Okay, so now we'll take a short break for 20 minutes and after the break, we will continue to work on a question number two. So kindly take a break. It would be 20 minutes break. Okay, students, welcome back. Okay, another question. Uh, First of all, look at the requirement. Explain why directors of Hudson are wrong to classify the basic settlement and additional pension contribution as a part of remeasurement component. Basic settlement and additional contribution as a part of remeasurement component, including an explanation of the correct treatment for each of these items, and also explain how any other restructuring cost should be accounted for. Now, remeasurement component, dear students, if you remember in IS 19, employee benefit, we have a post employment benefit, and in post employment benefit, we have defined benefit plan. And in defined benefit plan, we maintain a plan asset and we have a present value of the pension obligation. And there are various assumptions which we take in those measurements, which is known as actuary assumptions. And due to those actuary assumptions, there are remeasurement gain and losses. And those remeasurement gain and losses are reported in other comprehensive income. And then we have current service cost, past service cost, curtailment, settlement, net interest. Uh, these components we record in profit and loss account. And restructuring provision is an issue of IS 37. So let's go for the question. First of all, again, the background, very important. Hudson has a year end of 31st December X2, and they operate a defined benefit scheme for all employees. In addition, the director of the Hudson are paid an annual bonus depending upon the earning before interest, tax, depreciation, and amortization of Hudson Company. So they have a defined benefit scheme and they have an annual bonus which depend on the earning before interest, tax, and depreciation. Hudson has been experiencing losses for a number of years, and its draft financial statement reflect a small loss for the current year of 10 million. On 1st May X2, Hudson announced that it was restructuring and that it was going to close down Division W. A number of redundancies were confirmed as a part of this closure, with some staff being relocated to other divisions within H. The director have approved the restructuring in formal director meeting. Hudson is highly geared and much of its debt secured on a covenant which stipulate that minimum level of the net asset should be maintained. The director are concerned that compliance with the International Financial Reporting Standard could have significant implication for their bonuses and debt covenant. So they have a bonus which depend on earning before interest, tax, and depreciation and amortization, and in a current year they have a small loss of $10 million as well. And there is a covenant. If that covenant breach, which is debt to equity ratio, the debt need to be repaid. So keeping that thing in mind and keeping the requirement one, why they are wrong to treat certain items as a remeasurement component, we will be reading the relevant exhibit, redundancies and settlement costs. Hudson still require a number of staff to operate the division W until its final expected closure in early 20X3. As a consequence, Hudson offered its staff two settlement packages in relation to the curtailment of the defined benefit scheme. Basic settlement was offered for all staff who have leave before the final closure of the W, and additional pension contribution was offered for a staff who remained in employment until the final closure of the W. The directors of H only included an adjustment in financial statement for those staff who left prior to December X2. Directors have included this adjustment within the remeasurement component of the defined benefit scheme. They do not wish to provide for any other settlement contribution until the employment is finally terminated, arguing that obligation would only arise once the staff made redundant. On final termination, the director intended to include the remaining balance of the basic settlement and additional pension contribution within remeasurement component. The director and accountant have aware that this proposed treatment does not conform IFRS standard. The director believes that the proposed treatment is justified as it will help H maintain debt covenant obligation and will therefore be in the best interest of the shareholder who are the primary stakeholder. The director have indicated should accountant not agree with their accounting treatment, then he will be replaced. So, first of all, they have an issue of curtailment. Let's talk about the curtailment. Curtailment means that the number of employees covered by the plan have been reduced. Now, curtailment, dear student, is not the change in actuary assumption. Now, basically, the company want to treat the curtailment, redundancies, they want to treat as actuary assumption, actuary adjustment in actuary assumption, and they want to treat the gain or the loss of these curtailment to be recognized in other comprehensive income. Now, keep in mind, in other comprehensive income, in a defined benefit scheme, post-retirement benefit, only remeasurement component relating to actuary assumption and asset ceiling are recognized in other comprehensive income. The current service cost, past service cost, net interest cost, curtailment, settlement, they are all recognized in a profit and loss. Now they want to treat the curtailment settlement in a other comprehensive income, okay? And that is contrary to the accounting standard. It is very clear. It should not be recognized in other comprehensive income. It should be recognized in profit and loss account. Point number one. Point number two, they have one and other mistake, or you can say manipulation, whatever you want to call it, is that they offer two packages. One package is for all the employees, whether they stay with the company till the final closure or not, they will get the package one, which is the basic package. Now, as far as the basic package is concerned, for the basic package, provision for all the employees must be recognized immediately, and that should be recognized in profit and loss account. Now, first of all, not recognizing the provision for all the employees for the basic package is not as per the accounting standard, because that is offered to all, and for that there is an obligation on a company. Now, whether the employee has leave or not, the provision for the first package, basic package, should be recognized immediately. Yes, as far as the additional package is concerned, that is only offered to those employees who will stay with the company until the final closure. For them, you need to make a assessment that who will able to fulfill that service condition, and that expense should be recognized over the vesting period. Okay, so that is the another mistake done by the or the by the accountant or the director of the Hudson company. Now, as far as the restructuring provision is concerned, dear student, it is an issue of accounting standard IS 37. Now, restructuring provision is recognized when there is an obligation. When there is present obligation arise from the past event and outflow of account benefit is probable and cost can be measured reliably, a provision should be recognized. And constructive obligation in restructuring is only arise if there is a formal plan and that plan is communicated to employees. On that time, restructuring provision should be recognized, and that restructuring provision should include all the direct expenditure which are the consequence of the restructuring. But in those restructuring provision, future operating costs staff training costs, staff relocation costs, purchase of new system costs should not be included, should not be included. So these are the points which we need to discuss for this accounting issue. IS 19, post-employment benefit. They are wrong to treat the curtailment settlement as a remainement component. In remainement component, only actuarial assumptions and effort ceiling adjustment can be recognized. All others should be recognized in profit and loss. And the other thing, they are wrong to treat to recognize only the expense for those employees who have left the company and treat them as a remainement component in OCI. First of all, for basic package, for first package, provision for the total amount should be recognized immediately in profit and loss account. And for the remaining, for the second package, company need to make assessment and the expected number of employees who are going to stay with the company. Against those employees, the package 2 provision should be recognized over the period till the closure. So that was the accounting issue relating to curtailment and IS 37. Now we have a tax losses. This is IS 12, and the requirement of this explain whether a deferred tax asset can be recognized in a financial statement of the H in a year ended 31st December H2. So tax losses. It is IS 12. Now, dear student, tax losses on tax losses, deferred tax asset can be recognized, but only to the extent that future taxable profits are available or future taxable temporary difference are available. Only up to that amount. Other than that, if those are not sufficient, then the tax asset should not be recognized. That is the recognition criteria of deferred tax asset in IAS 12. So the director of the Hudson wished to recognize a material deferred tax asset in relation to 250 million of unused trading losses which have been accumulated at 31st December H2. They have a taxable losses which they have carried forward, and on those 250 million of unused trade losses, they want to recognize a deferred tax asset. Now, deferred tax asset can be recognized on the carry forward taxable losses. Yes, it can be recognized, but as I told you, only to the extent that future taxable profits are available. Now, we need to assess that whether the future taxable profits are available. We should be based on supportable assumption, on realistic assumption. Okay. But there is a guidance that if you, especially on the losses by IS 12, is that if the cause of the taxable losses is reoccurring in nature, means the losses are reoccurring in each year, then a deferred tax asset should not be recognized, because if the losses are reoccurring, that means in a coming year it would be reoccur again. So in that case, IS 12 discouraged to recognize the deferred tax asset. on the taxable losses. But if the loss is caused by a non-reoccurring event, like some natural disaster, due to some natural disaster, they have a loss in a current year. So natural disaster is not a reoccurring thing. So on that case, you might record the deferred tax asset, but only to the extent that future taxable profits are available. Now they have make a budget in which they have budgeted that in the next year they will be having 80 million taxable profit, and they believe that in each coming year it will increase by 20% in each coming 4 years. That is their claim, their forecast. But actually, the market is currently depressed and the sale order are at the lower level of the first quarter of X3 than they were for the same period any of the previous 5 years. Now, it is a strong evidence that their forecast doesn't based on realistic assumptions, realistic forecast, because they have claimed that in X3 they would have 80 million taxable profit, but in the first quarter, their sale orders are very low as compared to last 5 years. So their claim that there would be taxable profit is not sustainable. And further, the tax jurisdiction in which this company operates, they allow only to carry forward the taxable losses for 2 years. After 2 years, they will be expired, and in 2 years, if there is no taxable profit, you cannot utilize them. So, considering all the points, we will conclude that they should not recognize any deferred tax asset on 250 million because there is no sufficient taxable profit. There are no sufficient taxable profits available against which you can utilize your taxable losses. So, IS12 would suggest in this case that no deferred tax asset should be recognized. Further, one more thing. They have 10 million loss, a small loss this year, as you know, but the redundancy settlement, when we will carry out the redundancy settlement, the loss will increase. So it is quite impossible that they would have sufficient taxable profit in future. So if they does not have a sufficient taxable profit, then they cannot recognize a deferred tax asset. These are two pure accounting issues: redundancy and settlement and tax losses. And then obviously the third requirement is about identify any ethical issue which arise from the directive proposed accounting treatment and behavior. And your answer should consider the implication of accountant arising from the directive behavior. Now, if we talk about the directive behavior, it seems they are happy to manipulate because the proposed treatment that the curtailment, the redundancy should be treated as a measurement component means it should be recognized in other comprehensive income. It shows that they are deliberately presenting an expense in other comprehensive income so that the profit on which their bonuses are dependent, they remain unaffected. They remain unaffected because when the taxable losses remain unaffected, when taxable losses will remain unaffected, in that case, they will get the bonus. So that's why they are happy to manipulate the financial statement. They are happy to present the transaction in the wrong way. And it creates a question of integrity, objectivity, and professional behavior on the part of the director. And another thing, directors are in a senior position and they are asking accountant to do so. So there is another angle of intimidation as well. They are intimidating the director as well. So there will be an accounting issue or ethical issue for the accountant as well. So he would be feeling intimidating. So that would be for the implication of the accountant. Now, what is the way out for the accountant? For the accountant, obviously, first of all, he should not associate himself with these wrong accounting treatment because being a professional accountant, he knows that he is bound by the ethical framework of the ACCA, which require to work with integrity, objectivity, with professional competence and due care. So he should not, so first of all, he should talk with the director. If not, it doesn't work, he can go for the board of director, other audit committees, entities, and at the end he can consult with the legal expert as well that what would be the further way for him. Or ultimately, he can consider to resign from the job. Again, another issue that the director knows that the proposed treatment is contrary to the county standard, but they are basically claiming that our duty is to uh, serve the shareholder. So as far as our treatment uh, benefiting the shareholder, it is okay. But it's not okay. It's not okay because again, I would say that show compliance with the accounting standard is in the best interest of the shareholder. By manipulating, by window dressing in a financial statement, it would not help the shareholder in the long run. So that opinion is also need to be challenged. So again, you can see another, this is another question number two, where we have an ethical issue and an accounting issue. Same question number two. So here we have the answer. First of all, regarding the division W, the treatment of the curtailment or package to treat as a component, measurement component to recognize other comprehensive income has been discussed here. So repayment component is taken to other comprehensive income and it comprises of actuarial gain and losses such as return on plan asset which differs from the expected return on asset included within net interest figure and change in asset ceiling. These changes are recorded in OCI and they are treated as a remeasurement component. Actuarial gain and losses are basically experience adjustment arising for the due to the actuarial assumption uh, taken to estimate the pension obligation and the amount of contribution by the employer. It involves financial assumption which include assumption regarding interest rate, inflation, final salary of the employee. So these are known as remeasurement assumption, actuarial assumption, and these adjustments changes are need to be reported in other comprehensive income. The curtailment is not an experience adjustment. It is redundancy is not a experience adjustment. So it would be wrong to include it in other comprehensive income and then treat it as an measurement, remeasurement component adjustment. They should be recorded in profit and loss account. And then they are talking about in this paragraph about the treatment of the two packages. And as I told you, that the first package should be recognized immediately for all the employees, whether they leave the company or not. And it should be recognized in profit and loss account. And the additional pension contribution should only be recorded for those employees who continue to work for the company for the coming years until the closure of the division W. And for that purpose, the company need to make assessment and they have to record it over the closure period of the W. So on that case, they have to assess that how many employees would be able to complete that service condition. Then they were talking about the restructuring provision. The restructuring provision, we have talked about it. It is an issue of IS 37. Then the second part question was about the deferred tax. And here you can see the discussion on deferred tax asset, that whether a deferred tax asset should be recognized or not. So I would recommend you that kindly read this paragraph. Read this paragraph. So have you read it? So the basic principle is that deferred tax asset can only be recognized if you have future taxable profit. Means the deferred tax should be recoverable, and recoverability depend on the future taxable profit. And they're talking about especially for carry forward taxable losses, you have to look at the cause of the loss, whether that is recurring cost or non-recurring cost. And then they are applying that knowledge on the given case study. That the claim of the company is that they would have a future taxable profit, but actually the results are showing they would not have. And further, they can be carried forward only up to 2 years. So on those basis, all the given basis, the conclusion would be that no deferred tax asset should be recognized here. And then the ethical issue, they are starting that the bonuses of the director depends on the earning before interest, tax, depreciation, and amortization, and they are having losses. So obviously the director would be manipulating the result, manipulating the financial statement to minimize the loss. So they could be eligible for the bonuses. So they are willingly manipulate the financial statement. So it is against the integrity and objectivity. They want to report the expense in OCI rather than profit and loss account. Okay, and attention is clear. If they report, they somehow if they able to report it in OCI, it would not affect their earning before interest, tax, depreciation, and amortization, and they would get the bonuses. But that would be contrary to the accounting standard. And another area where their integrity is questionable, where they are claiming that they would have a future taxable profit, and actually they are not having, and that's why they want to recognize a deferred tax asset. So, and the direct action with regards, if we talk about the regards of the accountant, it is against the professional behavior. They are pressurizing the director, basically intimidating that they should follow the direction of the director. Okay, or if they do not, he may lose the job. So accountant would remember that he is also bound by the code of ethics, same principle, ethical principle with the directors. So they must not therefore comply with the director's instruction. The accountant should remind the director of their obligation to comply with the code of ethics, and should accountant feel unable to approach the director directly, they could consider talking to those charged with the governance, in particular non-executive director, and explain the situation. The accountant could also seek help from the ACCA ethical helpline and take a legal advice. Ultimately, if the situation cannot be resolved, the accountant could consider resigning and seeking employment somewhere else. Okay. Got it? Okay. Now, after having question number two, Now let's talk about question number 3, which will be in part B. Question number 3. Now, question number 3 normally would be involving the accounting issues and some other areas like the conceptual framework, APM. Uh, so, question number 3 mainly revolving around the accounting issue to evaluate the situation and to discuss the situation. Now, I have now the question number 3, and we have an accounting issue. Here, and if you look at the requirement, and let me tell you that in this question, I will totally ignore this requirement because it is relating to the amendment in ICE banking, which is already has taken place. So that is an old issue. So we will not waste any time on this requirement. But to having a sense that what topic, how the question, how the things can be tested in question 3, we will be focusing on requirement A and requirement B. So the first question, requirement is advise the director of the D company, advise on the recognition and measurement of the law music company share received as a revenue for sale of the 3-year license and how they should be accounted for in a financial statement for the year ended 31st December X6, and royalty which the Claw Music Company has agreed to pay as revenue for the sale of the 3-year license in a financial statement for the year ended 31st December X3, and your answer to A part 2 should demonstrate how it is supported by the revised conceptual framework for financial reporting 2018. So it is an accounting issue and it is integrated with the conceptual framework, that how the specific treatment regarding the license royalty is in compliance with the revised conceptual framework. So let's talk about first these transactions. So kindly, first of all, I would recommend you that kindly read the highlighted area. Kindly read it. Okay, so if you have read it, there is a company, D company, they have developed a digital music platform, and they have sold that platform to a company called Music, which is unlisted technology startup. A 3-year license of the catalog classical music to the public, under which they can sell it to the public. The catalog contains a large selection of the classical music which the company will regularly update over 3-year period. A revenue of 3-year license Claw Music has issued share to the D company equivalent to a 7% shareholding. Voting right attached to these shares. D company received the share on 1st January at 6, which is the first day of the license term. D company will also receive royalty of 5% of the future revenue of the sale of the Claw Music company as a revenue for the license. Claw Music company valuation and revenue. On 1st January at 6, the value of the share valued by the professional valuer, because it is unlisted company, so you have to use the services of the professional value, that was 4 to 5 million of the total company of the Claw Music. 4 to 5. So average value is 4.5 million, and you have 7% shareholder. So 4.5 into 7%, you can get your share valuation. The valuation is based on the share of the price of the controlling interest in a comparable listed company. Controlling interest. So keep in mind, it is overvaluation. First of all, it is based on listed company, and it's based on controlling interest. And we have just 7% in an unlisted company. And at the year end, Law Music company has generated a sale of $1 million. And at the 31st December at 6, at the year end, the valuation of the company is between 6 to 7. So 6 plus 7 divided by 2, it would be 6.5, and again your 7% share. So the requirement was how to recognize, if I look at the requirement again, yes, we have to advise the D company on the recognition and measurement of the share received as a revenue of the 3-year license, and how they should be accounted for in the financial statement for the year ended at 31st December at 6. Now, first of all, it is an issue of IFRS 15 revenue, and in IFRS 15, we are talking about determination of transaction price. Now, the transaction price, the factor in a transaction price which we will be considering primarily here, is a non-cash consideration. The D company get a non-cash consideration in the form of share of the customer company, Claw Music company. So it's a non-cash consideration. And as per IFRS 15, non-cash consideration at the transaction date should be measured at fair value. And the fair value is from 4 to 5 million. And if we take the average, it is 4.5. So into 7%, you will get the estimated fair value, and it is measured as per IFRS 13. And here they have used the level 2 inputs of the quoted of the similar quoted company to determine the fair value of the Claw Music. But keep in mind, in this assessment, they might have overvalued the company, because it is based on a listed company valuation and on a controlling interest-based valuation, but it is an estimated value. So 4.5 into 7%. Can you tell me the what would be the 7% of 4.5? 7% of 4.5 million. It is 0.315. So it is the fair value of the non-cash consideration. Now, on 1st January at 6, when we sold the license, on that date, the financial asset will be debited because it will be treated as an equity investment, 0.315, and contract liability will be credited. It would not be recognized as a revenue immediately because it is a 3-year period. In this year, we are bound to give them update services. So it's a 3-year period, so the revenue should be reported over the 3 years. So this 0.315 value of the revenue should be recognized as a revenue over 3-year period, first of all. And this financial asset will be accounted for subsequently under IFRS 9 as an equity investment, which by default is at fair value through profit and loss account, or company can designate to avoid the accounting mismatch on initial recognition at fair value through other comprehensive income. And at the year end, the fair value when becomes 6 to 7, so the average value is 6.5 million. And if you take the 7% of 6.5, that would be the closing fair value, and any change in a fair value would be reported in a profit and loss account or in other comprehensive income. Okay. And another thing which might be discussed here is we have a non-cash consideration which is in a form of share. So the value of the share is subject to change. That would change continuously. So there might be a hint that it might contain a variable consideration. In a transfer price, another factor is a variable consideration. But dear student, IFRS 15 is very clear. The variability of a transfer price, which is due to the nature of the instrument, cannot be treated as a variable consideration. Now the share fair value is the nature of the share, is the nature of the instrument. It is nature of the share that the fair value will change. Now that change cannot be considered as a variable consideration. Okay. So in this given part, we are discussing the revenue IFRS 15, in that we have talking about transfer price. In transfer price, we're talking about non-cash consideration. There is involvement of IFRS 13 fair value measurement, because Law Music is an unlisted company, so you have to use the professional valuers to value the company. So it is an estimated fair value, so you have to bring a touch of IFRS 13 in a discussion as well, and IFRS 9, because the non-financial consideration is in a form of the equity instrument. So IFRS 9 will automatically involve here. So dear student, you can first of all read this paragraph. So it's a non-cash consideration, and non-cash consideration should be fair value. If the fair value cannot be reasonably estimated, the consideration should be measured by the reference of the standalone selling price of the goods and services promised in a contract. The fair value of the non-cash consideration may vary. If the non-cash consideration varies for the reason other than a form of the consideration, entity will apply the guidance of IFRS 15 relating to considering the variable consideration. However, if the fair value varies only due to the form, the variable constraint guidance of IFRS 15 would not apply. Variable consideration is only included if it is highly probable that would not be reversed when the uncertainty is resolved. That paragraph would not be applicable here because this is the nature of the share that their value will change. There will be variation. So that could not be considered as a variable consideration. So the fair valuation of the share is an unlisted startup company is problematic. However, IFRS 13, as I told you, IFRS 13 fair value measurement gives advice how to measure the unlisted company. It set out three approaches. Market approach means such as transaction price paid for the identical similar instrument of an investee. Income approach and cost plus approach can be used. Here they have used the market approach, and on the 1st January at 6 on initial date, their estimated fair value was 4 to 5 million. So 7% of 4 and 7% of 5 would be 280 to 350. If you take the average and take the 7%, that would be 0.315 million. You can see here in that fair value, you will be recognized a financial asset and a contract liability. And this 3,15,000, 0.315 would be recognized revenue over the 3-year period, not at a point in time. And then the financial asset will be subsequently measured under IFRS 9 at fair value through profit and loss account or fair value through or other comprehensive income. And at the year end, average value is 455, 6 plus 7 to 6.5 into 7%, that would give you 0.455. And on initial date, the financial asset was 315 and now it is 455. So there is a fair value gain, and it would be reported in profit and loss account or in other comprehensive income on the basis of the classification of the financial asset. Then there is a revenue. So how the revenue, because there is a revenue as royalty as well on the basis of revenue each year, which the company will receive from the law music company. And at the first year, they have a revenue of 1 million. So revenue is based on sales, so it is also recorded over the year. But obviously, we cannot assess that how much revenue will be generated in each day of the financial year. So it would be appropriate that we record the revenue at a confirmed revenue value at the year end. So it would be quite okay that at the year end, on the basis of actual revenue, we record the royalty revenue in financial statement. So that as the D company retain an active role in the updating and maintenance of the sold license to ensure its continuing value to the client, revenue would be recognized over the expected length of the contract or related client relationship. An entity must be expected to undertake activities which significantly affect the license to conclude that revenue is recognized over time. However, reliable measurement of the future royalty is not available. Thus, in this case, the revenue would be recognized over the 3-year license based upon the license agreement. At the year end, however, revenue from the royalty can be calculated based on the sale for the period, and it would be 5% of the 1 million, which is $50,000. Now, the other part was that how the recognition of revenue is in compliance with the revised conceptual framework. So, dear students, the International Accounting Standard Board has changed the definition of income and expense in the revised conceptual framework to align with the revised definition of asset and liability. The definition of income encompasses the increase in asset or decrease in liability, which result in increase in equity other than those relating to contribution from holder of the equity claim. The revised framework also states that an item which meets the definition of element should only be recognized if it provides the user of financial statement the information which is useful, and that information will be useful, which is relevant and faithful. Relevance may not be achieved if there is uncertainty over existence or probability of an inflow of economic benefit is low. Faithful representation will be affected by the measurement of uncertainty. In this case, thus in this case, the royalty cannot be measured with any certainty in the future and should not be recognized until certain, as only then would it meet the relevance and faithful representation threshold for the framework. The definition of framework related to income and recognition are therefore consistent with the approach taken by the D company. So what is the approach taken by the D company? They are recognizing the revenue on the basis of the actual revenue, which is 1 billion, which will be confirmed at the year end. And according to framework, an element should be recognized if it provides more relevant and faithful presentation. So if we make estimate that what would be the revenue at the year end, and on that base we record the estimated revenue, that would not be appropriate. That would not be relevant. That would not be faithful. So the approach taken by the D company, that at the year end, when they have a confirmed revenue, then on that basis of the value of the revenue, they will record the 5% of the royalty revenue. That's why it is consistent with the principle of the conceptual framework, revised conceptual framework. Now, after that, in a part B, the classification of the investment which D company has in a 4D. Advise the director on the classification of the investment the D company has in a 4D and the derecognition of asset exchange for the investment in 4D company and any resulting gain or loss on a disposal in a financial statement of D company as at 31st December X6. So it is the relevant exhibit. So D company has agreed to work with the tech game company to develop a new music platform. On December X6, 31st December X6, the company is created a new entity, 4D company, with equal shareholding and share in profit. D company has contributed its intellectual property in a form of employee expertise, cryptocurrency with a carrying amount of 3 million. And that has a fair value of 4. An office building with a carrying amount of 6 million, which has a fair value of 10 million. The cryptocurrency has been recorded in a cost in a D company financial statement. The tech game has contributed the technology and marketing expertise. The board of the 4D company will comprise the directors appointed equally by D and tech game. Decisions are made by unanimous vote. So what would be the classification of the investment? First of all, whether it is a subsidiary. In order to be a subsidiary, you must have a control. And in case of control, you have a power to take decision, but decisions are made by unanimous vote. So you does not have a power to take decision. So it is not your subsidiary. So whether it is an associate, for associate you should have a significant influence, but here you have a decision-making power, but unanimous vote. So, dear student, it's a joint arrangement. It's a joint arrangement. IFRS 11. Joint arrangement is an arrangement where 2 or 3 entities come together and they create an entity or arrangement for which they agree to take unanimous decision. They have contractually agreed. Whatever decision will be made, that will be made with unanimous vote. Now, in that case, you have a joint control, and that is known as joint arrangement. And this joint arrangement is a joint venture. It's a joint venture. It is created through a separate legal entity. So it's a joint venture, and on joint venture, we apply equity method to account for in financial statement. So That would be the classification. And you have 50%. You have 50% voting right there. Can you read the answer? It's a jointly controlled. IFRS 7, joint arrangement, joint venture. Joint control because they have contractually agreed. And they have a right to net asset. And it exists only when they have contractually agreed to take the relevant decision about the relevant activities with unanimous vote. And according to I-28, on the joint venture, an equity method should be applied. Okay. Now, derecognition of assets for exchange for the investment in 4D company and any resulting gain or loss on a disposal of the financial statement of D company as at 31st December Act 6. So, dear students, they have transferred, the D company has transferred cryptocurrency and office building. Cryptocurrency cost is 3, office building pay value is 5, the building has a cost of 6 and pay value of 10. And they have transferred it to an joint venture where they have 50% interest. So, how the derecognition and gain loss will be recorded? So, they have 50%. Now, look at here. D company has exchanged non-monetary asset for investment in 4D company, thus need to derecognize the asset. It is contributing to 4D company. The carrying amount is 6 million. The property is derecognized. So the property with the 6 million will be derecognized. But the intellectual property of the D company has been generated internally, so does not have a carrying amount. The cryptocurrency is recorded as an asset in the financial statement of the D company at 3 million, but it will be valued at 4 million. Its fair value in the financial statement of the 4D company. So it will be recognized at 3 million, but in the 4D company, it will be recognized at fair value of the 4 million. Accordingly, the joint venture contributes a non-monetary asset to a joint venture in exchange for an equity interest in the joint venture. The joint venturer recognizes a portion of the gain or loss on a disposal, which is attributable to other parties to the joint venture, except when the contribution lacks commercial substance. Essentially, the D company is required by 28 to limit the profit on a disposal of its non-monetary asset to 50% because they have 50% holding in a joint venture. Okay. Effectively, D company has only disposed 50% of the asset contributed to joint venture. So, the carrying amount of the joint venture in D company financial statement December at 6 will be 11.5 million. So, they have 11.5 million. 6 plus 3, 9 million. They have given the cryptocurrency and the building, and then the fair value gain, the cryptocurrency fair value was 4 and carrying value was 3, so there is 1 million gain in which 50% belongs to the D company, so it will become part of the investment. And 4 million gain they have on the office building, 10 minus 6, in which 2 million is will become the part of the investment in 4D company. So 2.5. So 9 million, the carrying value, and 2.5 million will be the gain. So at 11.5 million, they will debit the investment. Look at here. They will debit the investment at 11.5 million. They will credit the asset at 9 million. So on the investment derecognition, uh, they will be recording a 2.5 million gain. Eventually, they have a 5 million gain total, but they have 50% share in a 4D company only. So they will be recognizing only 2.5 million gain on the derecognition of their investment in exchange for the investment in the 4D company. In the 4D company, the carrying value will be derecognized at 9 million and investment will be recognized at 11.5 million. So here you can see that they have, in question number 3, they have tested us with IFRS 15 and IFRS 11 and IFRS 9 and IFRS 30. So question 3 will be normally on accounting issues integrated with framework or other specialized area like APMs or sustainability reporting. Now, dear students, I am going to give you some homework. Kindly note this question. Question number 11. And question number 14. These two questions I'm giving you as a homework. So kindly attempt these questions by tomorrow. Okay? And just a minute. Let me share you. Let me share some files with you. And I'm sharing those files in a chat box. Just wait. Have you received the file? Volume 2. Kindly check the meeting chat box. And SBR Volume 1. Okay, from here you can revise the accounting standard. Okay. Now, dear student, in tomorrow class, I will be doing question number 3 and question number 4, and I will be discussing some specialized areas like sustainability reporting and APMs. Okay. So tomorrow my focus will be on question 3 and question number 4 and some important areas. So see you tomorrow. Until then, goodbye and take care.